My name is Michael Guyot, publisher of the Lead Lag Report. Joining me for the hour is Mark Roussin. Came across Mark from others that were following you, Mark, and I thought it was good to have a conversation here around dividends because there's quite a bit of interesting opportunities now. But Mark, for those who are not familiar with you, introduce yourself. Who are you? How'd you get interested in markets? And why did you specifically gravitate towards yield and dividend investing?
Yeah, Michael, it's great to be here. Thanks for having me. My background is I'm a CPA here in California. Had my bachelor's in accounting. Worked for a Big Four accounting firm for about 7 years, and then went into the world of commercial real estate and home building for a number of years. During the pandemic, really honed in on building out kind of my own brand here on social media. Started my own business with Roussin Financial, and just recently actually went full time with that. And there's a lot of exciting things that we have going on. Michael, you mentioned the YouTube channel where we do focus a lot on dividend stocks and building wealth by utilizing dividend stocks, ETFs, a lot of REITs as well. I'm here active on Twitter and Instagram. We also have a investing newsletter that goes out on a weekly basis, just kind of breaking down market trends and stock deep dives, again with a focus on dividend stocks, and then doing what I consider wealth coaching, where I'm working one on one with clients and just really helping them understand investing, portfolio construction, and things like that. So for me, getting into I like the passive income, the passive idea with how dividends come along. It's a safer way of investing for myself, and then just truly gravitating towards that power of compounding dividends is really what brought me into the world of dividend
Is there anything
stocks.
you miss about working at a Big Four accounting firm?
Not much. I mean, besides the late nights and missing the families, but I did take a lot of great things away from it. Really understanding how these larger corporations run their businesses, getting a new understanding on truly the financial statements and how these CEOs, CFOs can really change things to make it look a little different on how the business is actually operating. So there were a lot of positives, but can't say I miss it all too much.
Okay, so you have the accounting background. I'm sure that's obviously helpful when it comes to doing
Right.
analysis on individual stocks, right? So talk about how some of your education, some of your professional experience factors into screening for potential investment ideas.
Yeah. So a lot of my focus is first and foremost is fundamentals. So I'm in the 10Ks, the 10Qs, press releases on a weekly basis, and just looking through these different metrics I'm looking at. Obviously everyone kind of starts with price to earnings, but I break it down a lot further. Free cash flow is going to be a huge thing for me, especially as a dividend investor. That's where dividends are truly paid from. A lot of folks want to just look at your EPS payout ratio, but I take it a step further. I want to look at free cash flow, because that's really how much on an operating basis and true cash a company is earning. And this is really going to tell you the safety of a dividend, how much if they have debt on hand, how much they're going to be able to pay down on debt as well. So a lot of my analysis is going to be fundamental. I do some technical. It's very basic when you look at some of these other strategies and technicians that are out there. But I don't just toss it aside. So, but first and foremost, it's going to be focusing on the fundamentals of a business. Looking both at the balance sheet, income statement, as well as the cash flow statement, as I had mentioned.
So it's interesting that you mentioned that you don't really focus too much on technicals, but you still look at it. And as you were saying it didn't dawn on me until you said it that that's probably a truism that if you're going to focus much more on dividend investing, you really don't care about a chart because the idea is you're supposed to get some degree of consistent cash flow. So who cares about the price now? What matters is that money stream good?
Exactly. Yeah. It's all about the passive income, allowing, dividend investing is a form of a patient way of investing, because it's really that buy and hold for the most part. I'm going to use the technicals in terms of entry price when I'm looking to get into a stock, or add some there. I don't want to just ignore that, the technical side of things. I also do, ways to boost my income. I'll do a lot of safer, and I have the air quotes there, safer form of options trading as well. So, utilizing covered call strategies, utilizing cash secured put strategies, just as a way to, not only leverage stocks that I already own with the covered call side. But for stocks that I'm looking to get into, I'll use those cash secured put side as well, just as a way to generate more income on a monthly basis.
All right, so let's, since you mentioned, let's go with that as a direction for a bit here. Talk about what a cover call strategy is. How does it enhance income? What are the pitfalls and risks? And what do you think that people should be really considering when they implement such a strategy?
So with covered calls, you're really not leveraging cash. You're more leveraging stocks that you own. So one option contract equates to 100 shares. So if we use Apple for an example, if I own 100 shares of Apple, I can sell a covered call at a higher price. So if Apple's trading at $150 right now, say I have huge gains locked in Apple right now. I'm looking at the valuation, I'm looking at the technicals, and say this thing looks a little bit outdated here in terms of the run. I know with the Fed pressures, a lot of macro pressures on the stock market as a whole. And in the near term, maybe I think Apple's going to come back a little bit. Well, I can sell a covered call at, say, $160. So essentially, this is going to allow me to take in premium because there's going to be someone on the other side that's going to be buying that call and say, hey, I think Apple's going to go higher. I'm going to buy that call from Mark here. So for me, selling it, I collect a premium on day one. That's my premium to keep forever. And if the stock price stays below that strike price of, I think I said this one at 160, that's my gain. As I collect the premium, there's going to be a strike price, or sorry, an expiration date on there. So there is a elongated expiration date. So I do around 2 weeks out on these covered calls. I could go out to a month, but somewhere in the 2 week to 4 week range, I'll sell these covered calls. And again, if the stock price stays below, I keep the premium. If the stock price goes above that strike price of $160, well, that's where I will actually be on the hook to sell my shares at the $160 strike. So again, there's no cash component for me because I already own the 100 shares of Apple. I will give those to the person that it'll automatically be transferred to the person that bought those call options, and I'll be left. But again, I was comfortable getting out of shares of Apple at that 160 level. So you got to kind of weigh the risk there. But again, the downside is if we have a huge rip in the market and say Apple shoots up to 180, well, my gains are capped because I own the stock. And we sold that call option at $150. I had the strike at 160. So my gains are going to be within that $10 range from 150 to 160. But anything beyond that 160, I collected premium. But anything above that 160 to 180 is not going to be mine. So that's really the downside, is if the stock really rips higher prior to expiration.
Do you get the sense that with the explosion of options activity and interest, that most people are even aware of these types of ways of using options? It seems like from everything I've read and seen, and I don't know the actual hard data on it, that more and more options trading is used more for speculation as opposed to as a way of enhancing income, so to speak.
Yeah, I think that's a great point, and something I've seen a lot is especially on social media, you have a lot of folks that see these people post about huge gains in options trading, and a lot of what they consider YOLO trading and these get rich quick schemes. So for me, in my approach, I'm trying to kind of take advantage of that. A lot of these people saying, looking just to buy call options and buy put options, looking for a huge downside. Well, that's just going to juice up the premiums even higher. And the focus for me when it comes to options is really just focusing on a handful of stocks or so, and it could be ETFs as well. Like the triple Qs is one that I use. SPY with the S&P 500. A lot of these stocks have huge, or ETFs have huge premiums baked in, and a lot of people have gotten excited about the idea of options trading, especially the bull market run that we've gone through prior to 2022, and just the desire for people and young investors to try and get rich quick and not truly understanding the options market. So again, yeah, my approach is more of on the safe side of things and just adding more, um, uh, juicing those dividends is the way I like to look at it, a form of passive income for me.
And I'm going to assume this is just from my own experience from a social media perspective that just like dividend investing is kind of slow and steady and doesn't necessarily have these outsized periods of returns. Probably growing a social media presence, focusing on dividends has got to be the same, right? Because you go on YouTube, you look at videos that are trending, you look at things that people want to search for. It tends to be more the kind of get rich quick type of videos, right? And even on Twitter, to your point, FinTwit, you'll have somebody that shows some massive gain from some out of the money call option or out of the money put option that they did it, and those guys get all the attention and likes and retweets and follows, whereas that's really not sort of a sustainable growth trajectory for most investors.
Yeah, I mean, it's all about consistency. Sticking with it. We saw it in the bull market the last few years where I think we just crossed the 1 year mark. I had saw on Twitter this morning of the Upstart debacle where they were trading at nearly $400 and now they're at that 14. Well, a lot of those folks that were just aimlessly pushing a lot of these growth stocks without truly looking at fundamentals, valuations, sticking to the dividend investing strategy during those times where why would I invest $5,000 in the stock to make $100 in dividends when I can go over here and this stock was up 20% in the last 4 days. I think just understanding the history of the market, the ebbs and flows that go along with it, the consistency without having to worry about these big swings, those 20% swings, because a lot of these ultra growth stocks are down 60, 78, some of them 90% over the past year, and just understanding the volatility that comes along with that. I think the consistency that comes with dividend investing, the income that continues, whether a stock is up or down one day, a lot of these consistent dividend payers, I'm still going to be able to count on my dividend, and I can kind of cash flow that over the future years, and that's something that allows me to sleep well at night.
All right, now I want to focus on the word quality for a moment, because it's very easy for somebody to see a yield quoted on a stock. The yield obviously gets bigger when the stock price goes down, but quality sounds like it has elements of subjective analysis when really it should be much more quantitative, objective. Talk about how you define what makes for a quality dividend stock.
Yeah, I'm looking for consistency, companies that have how they've performed in slow times as well as booming times. So those consistent revenues, again, going back to strong free cash flows. This is kind of it also tells me a balance sheet can tell me a lot. How efficient are these companies about utilizing assets, utilizing cash? How much cash do we have on hand? When times get tough, how much can I be able to still rely on a dividend? So consistent revenues, strong free cash flows, a dividend growth. That's consistency. That's going to be more of these mature companies that are able to withstand economic movements, and then the payout ratios. And then lastly, it's going to be, which is going to go along with the efficiency of how well a company is run, is these strong management teams that have been in place. Something that comes to mind is Lowe's. Stock ticker LOW is a company that I like a lot. Home Depot and Lowe's. Obviously, the real estate market right now puts a lot of pressure on them. But I saw, how CEO Marvin Ellison, who came in just this 2 years ago, he was an ex. He worked at J.C. Penney for a few years, but he was also ex Home Depot executive. And just knowing how Home Depot is really a gold standard when you look at how efficient they run their company, from all of the efficiency metrics that you can look at, return on assets, and how well they're able to build their balance sheet. Just knowing that he's coming over to Lowe's, knowing the gap at the time between the two companies and how that has really closed over the past few years. That is something that I was looking at early on, and just seeing how well he continues to improve that company. So management plays a huge role in companies, especially dividend paying companies that I'm looking at.
I see some people want to ask questions. If you want to ask a question, just follow me and check your DMs, and we'll coordinate, and then I'll prompt you. It's interesting you mentioned Home Depot and Lowe's as examples of stocks that you look at. Do you factor in macro slowdowns at all? Maybe even just in terms of weighting a particular different idea. So, for example, in the case of Lowe's or Home Depot, right, you can make an argument that they could be having some serious headwinds, assuming that housing, which likely does, right, keeps on deteriorating. How do you factor in, kind of the broader secular cycle with the fundamental bottom up?
Yeah, macro is something that can't be ignored as well, and something I take into consideration at a good portion. And again, that's kind of what at I call it the Dividend Investor's Edge, is that weekly newsletter that I put out. And the weekly one is really focused on macro as a whole, and just helping investors understand what has been going on in the market, what to look ahead for. If there's big, say we have a Fed meeting, a rate hike that's coming, or a potential rate hike. And so macro is a big component. And you had mentioned the housing slowdown, and then on the kind of on the flip side of that is I'm looking at, okay, well, we have interest rates that just went from sub 2%, and now what folks are paying over 7%. And the power that uh, what you can afford now is much less. So there's going to be a lot more folks that I'm going to see now staying put in their homes, and deciding not to move, which can kind of bring back those Home Depot customers, those Lowe's customers. So albeit there are some there's natural headwinds for those two companies. I do see that other side of the component too, and that's really what the boom was during COVID as well, was a lot of folks that were staying put just because of lockdowns. It wasn't because of interest rates; it was more so because of lockdown. So to answer your question, yes, macro is a key component to look for. And if you were to look at if I were to open up my portfolio right now, you would see that healthcare is my largest exposure. So, albeit I'm a buy and hold investor, I'm not a buy and just forget investor. I'm going to make trims where I see valuations or headwinds for certain sectors down. Energy has creeped up is one that in 2022 that has crept up my portfolio list. And again, healthcare. So at the top, you're going to see companies like a J&J, AbbVie, Bristol Myers Squibb, and then obviously a lot of ETFs. I think that's a major component, and should be a major component of anyone's portfolio, regardless of whether you're a growth investor or a dividend investor.
Let's go with the ETF side for a bit. I want to go back to healthcare shortly, but if you're looking at ETFs for dividends too, what types of ETFs do you like to focus on, and why then bother, I guess, with individual stocks, right? Because if it's a strategy in an ETF wrapper, it's tax efficient, as we know. Why not just make that your sole opportunity set?
So when I'm working with clients or talking to folks about investing, I always focus on ETFs being at the center. You want to have a strong backbone. This is the same for whether it's investing, relationships, at work. You want to have that foundation that you can fall back on when times get tough, especially what we're going through right now. And they add diversification. The ETFs that I focus on are going to be low cost, because you want to be careful about expense ratios. Those can really eat into fees over the years. But having that, for me, it's a 40 to 50% weighting ETFs as a whole. So for me, the S&P 500 is going to be a major focus always. That's just going to be your ultimate diversification ETF there. But in terms of dividend ETFs, the ones that I focus on primarily, SCHD, so that's a Schwab U.S. broad-based ETF, but it offers some nice growth potential. It offers a nice yield, but it also offers strong dividend growth. And I'm going to mention some of these dividend growth focused ETFs, but actually SCHD is outpacing those in terms of dividend growth over the past 5 years. So that's actually my favorite dividend focused ETF. Again, that's SCHD. Other ones to consider is the an iShares dividend growth. So you have DGRO. You have a Vanguard dividend appreciation ETF, which is VIG. And again, both of these are focused, dividend focused ETFs, but they're looking more for companies that are growing their dividends on a consistent basis and increasing those. So you're going to see a lot of names like Lowe's and Home Depot, like Visa. You'll see some Apple in there. And again, those two are lower yield, but they're also increasing their dividends. So, Apple increases at a 10% rate. Microsoft increases at a 10% rate. Visa's up near 20% in terms of dividend growth over the past 5 years on an annual basis. And then, on the flip side, if you're looking, hey, I don't want the dividend growth, those, 1% dividend yields. I'm looking for a little bit higher yield, then there's the Vanguard high yield dividend ETF. And that's VYM. So they're going to look at, more for the mid-range and higher yield. So you're going to see maybe a lot of REITs on there. You're going to see something like an Altria group that has 8% dividend there as well. So, and another way for me is you can look at REITs. That's I try to, I have roughly about a 20 to 25% exposure, I would say, to REITs. And, I partner with Brad Thomas, who you had on the lead lag on multiple occasions in the past. So, him and I partner together on Seeking Alpha with a lot of REIT material there. So, that's really opened my eyes a lot. Working with him, and that's a kind of a major focus where you can find yield if that's where what you're looking for, and especially if you're towards retirement and looking for just not looking for the growth but looking for higher yield. REITs are a great place to look.
I wonder how the reversal in trend around share buybacks might impact dividend investing. And the reason I say that is, traditional finance would argue that there should be no difference to the end investor, whether it's a company that's paying out a dividend or reducing its shares outstanding with the same amount of dollars. Now you've got, taxes, being elevated on share buybacks, and obviously higher interest rates, which probably makes it less palatable for CEOs. Do you get the sense that there might be maybe sort of a little bit of a renaissance of more and more interest towards dividend heavy stocks just because there's not going to be as much buybacks as sort of the siren song?
Yeah, I mean that's a great point to bring up. I think in the near term, with the knowing that kind of that buyback tax is coming, I think we're going to have a big swing in share buybacks here towards the end of the year. But then, yeah, like you're saying, that could flip. Especially in these volatile times, not only are folks looking more for passive income, but they're looking more for safety and consistency, and that's one thing that dividend stocks can. A lot of them can provide to an investor. It's not guaranteed. We saw it during the pandemic where, especially in the REIT sector, you could have dividends that are cut. What we say is the safest dividend is the one that's just been paid or raised. But a lot of these companies, that's why you want to break down the fundamentals and look at the how much safety is there, how much coverage is there in terms of free cash flow. But in terms of your question, I think after we get past this year where we're going to go into that tax event, I don't think it'll have a huge impact, just being that it is so low. But it could sway a lot more of these management teams on moving, some of those dollars more towards investing. And then in terms of investors' portfolio, with dividend stocks, people ask me, a lot of the time is in terms of my account. Do you have all of your dividend stocks and retirement accounts that are like Roth IRAs, or are you in traditional? Well, I build out a lot of my Roth IRA is filled with dividend stocks, and a lot of I have a lot of REITs in there. So that's to answer that question that I get a lot. Yes, I try to hold as much as I can in terms of the dividend stocks in those tax deferred accounts.
All right, let's talk about sort of the link between uh, dividend stocks and sectors which have more dividend payers, and everything else, especially when you're in more volatile environments broadly, right? So I've often made the argument that it makes sense that in high volatility states, money would flow into healthcare, consumer staples, utilities in particular, because uh, you can have high volatility, but these tend to be lower beta, less sensitive to the broader market. But also, I think there is a perception among investors that if you get that income right through a dividend, okay, fine, then who cares what the price is doing because you're getting a cash flow. Um, do you see any? Have you done any research or see anything that would suggest that in a prolonged period of heightened volatility, money does tend to flow much more to dividend plays as opposed to capital appreciation plays, which is much more growthy.
Yeah, so for me, when I kind of break down dividend stocks, is I call it the total return investment, because I don't want to focus, when I'm kind of forecasting out, I don't want to just look at, this is going to be my dividend income. Well, I understand, because I do a lot of investing in dividend growth stocks. So it kind of offers me that a little bit of growth potential, albeit the yield's going to be a little bit lower, but also get that dividend growth. So that kind of comes back to the calculation of yield on cost, which is, how much did I originally invest and how much is that earning in dividend income now, say 10 years later. So something like Iron Mountain is a REIT that focuses on, they're moving more towards data centers. They're the paper shredding company that you see, records management company. And, at the time right now, if you were to buy Iron Mountain, you're going to be getting a 4% yield or so. My yield on cost is closer to 9%. So, it's looking at the total return investment. And I think that idea is what a lot of investors like, but it's also tough for them to see, especially, younger investors, just looking at that year one dividend and not understanding the idea of how compounding works, and how that dividend snowball effect can come into place. Because, when you're getting paid that dividend, you can, automatically go into your brokerage and turn on what's called DRIP, which is that dividend reinvestment plan, which is just going to take the dividend that you were paid and it's going to reinvest those back into that same security that just paid them. So if, again, we'll stay with Iron Mountain. If Iron Mountain paid me $100 in dividend, I can have my drip on. It's going to turn around and pay and buy $100 worth of Iron Mountain. So it's really a way of, I'm not adding any more money from my account in a way. So I didn't take any money out of my my Wells Fargo account or whatever and put it into to buy more Iron Mountain. It's just automatically, and that's that compounding effect that I think draws a lot of people once they truly understand the power of compounding and how dividend stocks work. It's not that year one. It's not that year one dividend income. It's that year 10, year 20 dividend income that really makes a difference. And that's really how, Warren Buffett has built his wealth over time. And when you look at his yield on cost for some of these companies, it's just outrageous for some, like Coca-Cola and stuff like that. Sure. So I mean, looking at, I'll go through REITs and regular dividend paying stocks first. So trying to look at that consistent revenue growth, the consistency there. But it kind of goes back to what I'd mentioned early on is the free cash flow and looking at the payout ratio, the coverage that we see, and kind of it goes back to also the macro stuff that we talked about. Is this company in a sector that's really going to struggle here going forward, where the free cash flow might be X right now, but in a year right now where we have a pending recession looking at us, potentially, depending on who you ask, this business is going to hit a rough patch where maybe the dividend is still slightly safe, but maybe we're going from seeing 15% dividend growth down to 1% dividend growth, or we're going to have it be flat. And looking at REITs on the other end, REITs are a little bit unique in the fact that we did go through a fair share of cuts during the pandemic, is because being a REIT, you get to kind of skip out on the corporate taxes, but there's certain rules that you have to follow, and one of those being is you have to pay out 90% of your taxable income out to investors in the form of shareholders. So with REITs, you're going to have higher payout ratios. And if you look at sites like Seeking Alpha, a lot of these companies don't track REIT payout ratios correctly because they just want to look at EPS for everything. And with REITs, it's a little bit different. Is you don't want to look at earnings per share because owning real estate, you have huge amounts of depreciation that go into that, which is just a fancy accounting term for writing off buildings over a 30-year period. It's a non-cash event. So instead, you want to look at what's called FFO, funds from operation, or even take it a step further and look at adjusted funds from operation. Just think of that as, in a non-REIT world, looking at adjusted EPS. So with that is you want to look at the adjusted funds from operation payout ratio just to kind of see what type of coverage they have. And in terms of those ones, I'm going to look at more at companies that can kind of adapt to the world we're in right now. So we're in a period of high inflation right now. Some of these REITs, like think of self-storage, they can change their pricing on a dime. Something like apartment REITs, pricing can be changed pretty quickly, whereas things like net lease REITs that have long 10, 15-year contracts that go out, those are really locked in for the most part. And you're going to have rent escalators that go in there. So they don't have that flexibility as much. So, but to answer your question in terms of safety, it's going to be, for REITs, it's going to be the FFO, AFFO payout ratio, the macro headwinds for the sector that we're in, and kind of along the same lines for non-REITs as well, just not looking at AFFO. We're going to look more at free cash flow, operating income, and the sector that we're in, as well as the macro headwinds. Yeah, and I think you bring up a great point. Is when it comes to dividend, you don't want to see that these companies, one, ever really using debt to pay dividends. That just tells me that's kind of the red flag right there, that this dividend may not have a lot left in the tank, at least especially in the near term. So bringing in the debt component is a huge factor there for companies that do have high amounts of debt. And that's a great point, because with REITs, you have to, because you're just not allowed to take on reinvest as much back into the business all the time, just given their specific rules. And this, the same is for non-REIT companies. A lot of these companies do take on tons amount of debt, and that can be a kind of a negative factor when we're looking at companies that consistently pay their dividends, and some of these that are striving to be or are already dividend aristocrats. They want to be able to stay on this prestigious list that says, hey, this company has paid their dividend for 25 plus consecutive years, increased it every single year for that amount of time. They may be, in a way like, hey, we still have to keep paying this dividend, so we stay on this list. This is why a lot of folks are invested in us right now. It kind of reminds me of the debacle of AT&T and their fall off. That's a whole nother story on mismanagement and stuff. But just understanding that debt component, and AT&T has massive amounts of debt over there. And so yeah, you bring up a great point. Is you do not want to see, when it comes to dividend stocks, companies, number one, paying their dividend, but definitely not consistently paying their dividend utilizing debt. Yeah, no, great question. And, again, happy to be here. Thank you to Michael as well. When it comes to dividends, I think it really comes down to the individual investor in terms of a drip or taking cash. For me, I'm in the market every single day. And in my early years, I always had the drip on. It was more of a hands-off approach. I had I had the 9 to 5, or I couldn't be on in my account every single day. It's just an easy way to for investors to be hands off. And even if you're in the market every day, maybe you do still want to be a hands off investor, which just turning on that drip is an easy way to kind of build wealth and allow that compounding process to take place. For me, I would say probably half of my investments are on drip, and it's something that I analyze on a monthly, quarterly basis. Is just really looking at valuations and knowing when companies are going to be paying out dividends. If I see a company that's paying out a dividend that maybe I don't have a ton of confidence in, maybe it's a sector that I see struggling in the near term, something like technology. But if healthcare on the flip side, that's probably something that I still have turned on, and that kind of moves on to your other question is in moving on to 2023 and looking at the different sectors. So again, right now I'm top heavy with when it comes to healthcare. So if I were to open up my portfolio, you're going to see Johnson Johnson, AbbVie, and then as well as something like XLE. So with energy still right now. So that hopefully that kind of helps answer those. But in terms of the drip, I think number one, it comes down to whether you want to be hands on or hands off, and just taking those cash profits and kind of redistribute them as you see fit, which is a method that I use a lot because, again, I'm a hands-on investor looking at different valuations all the time. I may take something from, say, an Altria group that's going to pay me an 8% dividend and turn around and say, okay, well, I saw a fall off on something like, I don't own this stock right now, but Target, they had a big fall off, or they've had a huge fall off in 2023. That may be a better place to kind of put my money to kind of initiate a position and build hopefully long-term gains and some dividend growth there as well.
Mark, how do you think about yield competition? Right, because it's not just now that there's more dividend ideas that you can play with, but obviously now your dividend stocks are competing against bonds. I actually think they're competing much more against CDs. I mean, certificates of deposits, which everyone left for dead for a long time, are actually, I think, where the most interesting near-term income opportunities are, because there's also a guaranteed aspect to it up to a certain amount. But how do you think about how higher yields across the board um, allow for, or maybe don't allow for, interesting opportunities when it comes to stocks as opposed to bonds?
Yeah, that's a great question, and actually one of the ones I get a lot is kind of going back to REITs is how, and I think it kind of is similar. Is REITs are known for their a little bit higher yield in a way, but over the past few decades, REITs have actually been one of the best performing asset classes, if not the best performing asset class. Outperforming the S&P 500 in terms of total return. And a lot of folks say, okay, well now we're in this period of rising interest rates. REITs are known for paying solid dividend yields. You may get slightly less in terms of share appreciation, but when you look at the correlation between REIT total returns and 10-year treasuries, in a time of rising markets or even tightening cycles, REITs have actually went hand in hand with those. So I think in only 3 instances was it kind of the opposite. It kind of shows you that there's you still have a strong economy based on the data right now. And it really increases the underlying real estate for REITs. So in these periods of high and rising interest rates, REITs have still proven to be a good investment, and really the time tested. Looking back at the data over the past 20 years, REITs have been a high performing asset class. Something that a lot of folks, I don't at least retail investors haven't truly understood the power. And I think it's gaining momentum in the retail world, understanding that it's another way to get involved and have that real estate exposure, which is one key aspect that I really appreciate and like to have in my obviously I'm getting my dividend, I'm getting a nice yield, but I'm also allowing to expand my portfolio and get some of that real estate exposure as well. So that's kind of a unique thing, a question I do get a lot, especially as it pertains to REITs and the 10-year Treasury.
I've done some quantitative back tests on REITs. REITs are really unique in the sense that there are times when it acts like a risk off sector, meaning they outperform in high volatility, and there's times where they outperform in low volatility and they're like a risk on sector. So there's not sort of a consistent degree of where you bucket it, right, in the context of offense versus defense, depending on volatility dynamics. But also, even from a momentum trading perspective, REITs tend to have, from my own research, much more quote unquote underreaction, meaning more streaks in performance. And there's some logic to that, right? Because you don't necessarily know what the value of properties is real time.
Sure.
So investors might be more conservative in how they're pricing a stock because they don't really know the underlying value of the assets, minute by minute, right? So it's just kind of more of an interesting dynamic. I've always found REITs to be fascinating from a quant strategy perspective.
Yeah, absolutely. And I think I may have briefly touched on it, but there's just so many sectors of REITs, and obviously there's ETFs as well. You think of VNQ as a way to get that broad spectrum, but I like to kind of focus on individual REITs, so I don't necessarily own a REIT ETF just because it's something that I am hands on a lot of is in the REIT sector, and again writing with Brad Thomas and partnering with him. But I think the unique thing about REITs is it's just like the regular stocks where you have your healthcares, your big technology, your semis and stuff like that. It's the same with REITs as you have these what's called net lease REITs. So you think of something like Realty Income, which is a popular, paying that monthly dividend, also known as the monthly dividend company. You also have self-storage companies. So you think of public storage. And then one, I think if I were to look at my portfolio right now, I would say my highest exposure is to Vici Properties, which is a gaming and hospitality REIT. They're the largest landlord on the Las Vegas Strip. 45% or 50% of their entire exposure as a portfolio is there in Las Vegas. So they've honed in on that sector, and that's whether times are booming or we're going through a recession. Looking back at 2009 or something, you're hard pressed to go to Vegas and find vacancies there, right there on the strip. And Vici now is the largest. They own property assets. You think of Caesar's Palace, you think of the Venetian, you think now of MGM Grand, something they recently purchased. They have even Excalibur. They have New York, and all of these assets that you look at. It's just really fascinating there, and you're going to get so you get exposure to real estate, that property there, and you're also going to get a nice dividend. So, and again, they're not the ones. They have operators that are operating these casinos. They're just truly the landlords there, and it's hard pressed to find a time when Vegas real estate in a whole struggles. So that's kind of the unique thing that I like about REITs is you can find them in the healthcare sector, the gaming and hospitality, hotel REITs, self-storage REITs. You could have data center REITs. American Tower is one where you could play the cellular game with AT&T, T-Mobile, or Verizon, but you're seeing it right now with the new iPhones that come out, and how these three companies are just grappling and fighting with each other to try and get customers. So their customer acquisition costs are through the roof, but yet they need strong coverage. And who do they go to? They go to American Tower, who's the one that owns all of these cell towers, and they have these single tenant cell towers, they have dual tenant cell towers, and they have the Tri, which is all three of those are on one, which it skyrockets their margin. So I'd much rather play something like American Tower if I'm looking at cellular, and that kind of continue to talk on that one. Is with 5G and the rollout of 5G across the nation and internationally, is 5G has 10 times, 100 times, whatever it is, the speed of 4G, but how far that data can move and transfer is only roughly like 10% of what 4G was. So that brings in a higher need for more cell towers. And who does that benefit? Something like American Tower. So, that's another way to look at things, is to look at these dividend paying stocks from one standpoint, like a AT&T or Verizon, but look on the flip side and who's providing all the infrastructure and the real estate component. And that's something like American Tower. Yeah, so that's a great point there, and Caesar's kind of that prized possession for Vici, and they have a lot of master trade lease agreements with their operators, so they'll have a ton of different casinos that are kind of built into these master trade agreements. And it's just under all one contract, but yeah, they do have the rent escalators in there. A portion of them are pegged to CPI. There are maxes on there, and you bring up a good point, and that another REIT that's like that if you're interested in REITs is to look at is one called WP Carey. That's stock ticker WPC, and in the past they've had a huge exposure to office. They also had a management side of the business too that's kind of dwindling down. But over the years, over the past 5 or so years, the company has moved itself and positioned itself strongly in the warehouse and industrial space. So, actually the timing ended up working out great because once we hit a pandemic, a lot of folks are saying, with people working from home and moving out and more into the suburbs or the rural America and stuff like that, offices aren't, as much of a need anymore, which is, shown in the office REIT sector, especially. But something like WP Carey with industrial and warehouse, that's a huge play on e-commerce. So if you think e-commerce is slowing or going to go away, we're going to go back to traditional brick and mortar. One, I would say I don't think that's the case, but I'm a huge proponent on industrial warehouse right now, and the growth in e-commerce over the years. We may be seeing a slowdown right now with a recession, but the going back to the idea of rental agreements being pegged to CPI. They have 50% of their portfolio to warehouse into industrial, but I think it's, and don't quote me here, I think it's roughly 55% of all of their leases are pegged to CPI, and some of them don't have a max on them. So that was kind of a fascinating portion on these rent escalators. So that's kind of a huge tailwind for something like WP Carey with these rent step ups that are going to be coming for a lot of these operators in industrial. And going back to Vici, it's very a high barrier of entry. You can't just pick up a casino and move it. Say you want to go out to Tahoe or something and move the whole casino over there. It's very difficult to do that. So not only do they have these long term assets, they have these long term leases, and they have these operators that have worked with them for a number of years. And it's a very difficult business to move, and that's one reason why they saw 100% occupancy. And we're collecting at 100% during the pandemic when other REITs were down at 50, 60% or even lower. So that was a fascinating piece of to touch on with Vici. That's an interesting one to kind of think about, and I guess it depends on. I mean, what wouldn't it depend more on? Whether it being a dividend growth stock. So think of something like even you can even go with American Tower. American Tower is increasing their dividend at a 20% clip. Yeah, I can see where that's coming from. That anything above, you're saying, if you spread it out over, say,
So
we'll just say a
if
10-year
I
period. Yep. Yeah. I was gonna bring up. So there is going to be that piece of the component of premium or risk that you're going to be taking on with that. But yeah, generally anything above and beyond, like you said, would be alphas. That's a kind of a unique way to look at it. So yeah, I mean that was a great point.
I am curious, Mark. Let's go to healthcare for a bit. Any particular interesting names that you're either invested in or thinking about investing in that are worth maybe paying some attention to?
So for me, one of my favorites, and I trimmed it a little bit just because the exposure was getting a little bit high, and I've kind of written about it a lot on Seeking Alpha over the years, but has been AbbVie, stock ticker ABBV. So AbbVie, I like to consider them the investors trifecta, and the reason I've called it that for a number of years being is when I first saw AbbVie, they had a dividend yield that was in excess of 5% when I started investing in them, and I think the stock price initially was in the 80s or so, and they had, if you're unfamiliar with AbbVie, they had the best selling drug in the world for a number of years in Humira, and still happens to be here in the U.S. And for years they were kind of a one trick pony, but with Humira accounting for roughly 70% of the total revenue for the company. But again, it was the best selling drug in the world for a number of years. And the reason I call it the investors trifecta is because they offered growth potential in the share price. They offered a high yield dividend. I was getting 5%, but at the same time, they're also giving me dividend growth that was near 20%. I think they're at 17 and change show over the past 5 years on an annual basis, increasing that dividend, call it 18% per year. It was kind of a perfect investment for me. Looking at the fundamentals and the components of the strong pipeline that they have, and now I think folks have caught on. The stock's up at 140, 150, whatever it is now. But we've lost patent protection of Humira over in the international markets, which you've seen Humira drop off drastically. And now in 2023, Humira is going to be dropping off here in the US as they lose patent protection as well. And other generics are able to kind of come online in 2023. But if you look at the results, Humira now only accounts for less than 40% of total company revenues. Now, it's not going to go away completely. They're still making sales over internationally, and they're still going to make sales here in the US just due to the effectiveness of the drug. But the pipeline is now coming to fruition. They a few years ago, they bought Allergan, and they've really diversified their portfolio to where they have other drugs, and you may have seen them on commercials on TV with Skyrizi or Invoke. They did one with Johnson Johnson and Bruvica, and all of these are performing quite well. They have high expectations for what the peak that these drugs can reach in terms of total sales. Now, they're not going to be a Humira, but it's going to be more of a sum of the parts. And I really like the direction of where the management company is taking that. They still have a solid payout ratio, so the coverage is still there. I think the dividend's around 4% now, just given the growth in the stock. But that's still a name I like long term. With the patent protection of Humira kind of dropping off in 23, sales are expected to slow because as I mentioned, Rinvoq and Skyrizi are still in their infancy stages, but they're growing at a rapid pace when you look at the growth of them. So I think 2024 is really when things kind of kick back into high gear. So if I see AbbVie kind of come down, I'm going to look to add back to my position there. I think Johnson & Johnson with Kenvue, their roll up or roll out of their consumer health. So, they own everything from Band-Aids, Listerine, toothpaste and Motrin, Tylenol. That piece is going to be rolled off of the Johnson & Johnson, and they're going to focus more on their pharmaceutical and their medical device sales, which is a fast growing segment. It'll be interesting to kind of see how the dividend plays out there, because consumer health is that slow growing, but it's still that cash flow printing machine that allows them to pay a dividend each and every year. And then, outside of healthcare, I would say, Starbucks has been a name that I like. And, they have a new CEO there. They're have a big play on China. I know it seems like there's a Starbucks on every corner here in the US. The company has over, I think it's 35,000 stores. But the loyalty of the rewards members, they have nearly 30 million active rewards members, people that have used their Starbucks rewards in the last couple of months there, and that just continues to grow year over year, quarter over quarter. And the growth, just to kind of give you an idea on the growth over in Starbucks, they're expecting this is not just like in the next 12 months, this is over the next 3 years. They're expecting a new store in China to open up every 9 hours, which was quite fascinating, and to kind of put into perspective the growth that they're looking for over in that region.
And maybe for the final few minutes, I think it's always important to think through sell discipline, right? So you can do all the due diligence in the world, but sometimes things happen. Dividend yields have to get cut. Dividends have to get cut, rather. What makes you totally abandon a position you already have? And has there ever been a situation for you, Mark, where you're in a stock for the dividend gets cut, but you still hold on to it for other reasons?
I had some, during the pandemic, I had, a number of REITs that would get that had their dividends cut. And for me, it goes back to I always want to have a thesis on why I invest in a stock. You look at the fundamentals, but generally put together a thesis on why you invested the stock, and analyze that over whether it's quarterly, every a couple times a year, annual basis. Go back and look at your thesis. Is that still intact? The reasons that I originally invested in the stock, is that still the same reason today? Is the company operating on what I expected and what I saw when I originally invested? That's number one. And then looking at the dividend, a dividend cut is a red flag for me. But it goes back to the fundamentals of the company and why they do it. Was it a forced thing? And one name that comes to mind is Simon Property Group. They're obviously the largest mall landlord. Again, going back to another REIT here, so their stock ticker SPG, they pay a high dividend, but their dividend was cut during the pandemic, and for what good reason? Everyone was locked up in their homes, and no one was going to the shopping centers that they own. But again, I understand the quality of the real estate that they own. They own some of the highest quality malls, premium outlets out there in the U.S. today, and people still want to go shopping. And when you see a lot of these mall closures and you see it in the news, it's a lot of these C and D rated malls, even some of them B rated malls. Simon Property Group has an A-rated portfolio, and how these are classified is based on their retail sales per square foot. So it's not just them classifying or some it's data based on the tenants that you bring in. What is their retail sales per square foot? And there's a classification, A plus, A, B, C, D, and a lot of these C and D are the ones that we're shutting down. Well, Simon Property Group, when you look at them, they're um, they're an A-rated mall based on their increasing retail per square foot. And a lot of folks were saying malls are dying, malls are dying. Well, if you continue to look year over year, Simon Property Group continued to increase leading up to the pandemic, and now they're starting to see that uptick in traffic once again. So I understand the quality there. Dividend got cut, but it's still a stock that I held on to, and I have trimmed in periods in between, but didn't just completely sell out of it just due to a dividend cut.
All right, for those that want to track you, Mark, on a go-forward basis, get a sense of your ideas, your thoughts, what are some of the best ways people can reach you?
Yeah, so here on Twitter, I'm just at dividend_dollar. So I write multiple tweets throughout the day. You can also find me on YouTube, and that's just under my personal name, which is Mark Roussin, Roussin CPA. So we have a growing a YouTube channel there, and then the Dividend Investor's Edge is my weekly newsletter, completely free, that goes out on a weekly basis, and you can find that on Substack.
Very good. Thank everybody for joining. I'm doing another space at 9 Eastern tonight, talking options. And everybody, if I don't see you, enjoy the rest of your day. Thank you, Mark. Really do appreciate it.
Thank you, Michael. Have a great day, everyone.
Cheers, everybody.